Hi, everyone. This is Paul Fouché, Chief Investment Officer at New Road Capital, just giving you your September market update. So, sort of we've been saying, we still think this bull market will continue to run, and just another great month for asset classes. So, equity markets up quite handsomely in September. The local all share up 6.6% for the month. Developed market equities up 3.3%, and then emerging market equities up 7.2% for the month. So just a really good, really solid bull market that we're still reaping the benefits of, and really good performance all around. If we look at inflation in the US, inflation is sitting at 3.1% on the core and then 2.9% on the headline number. Slightly raised, but still slightly above that 2% target, but definitely not the sort of higher inflation or what's been expected in the markets. And on the back of that, you actually saw the US Fed dropping rates by 25 basis points. Even despite the still slightly elevated inflation from the 2% target. So, it's an indication to us that they don't see inflation becoming an issue going forward. And they've finally moved around to our point of view that we've held for the last few months. So, still elevated, but not really climbing strongly, and not so the fear from the tariff inputs just really not coming through there, which has been bullish for both for obviously for equities, and we think continues because you'll continue to see, we predict probably another 2 cuts in the US this year, 225 basis point cuts before the end of the year, which generally is quite supportive of equity markets. On the back of that, you're also seeing just increased earnings coming out of the US equity market. So this rally is not driven by increase or by re-ratings in the businesses. In other words, the business is getting more expensive. It's actually driven by earnings coming through. So as these businesses report on earnings, these earnings are very solid, very robust, and they're coming through very nicely. So still high quality businesses with good earnings growth, and that's what's driving this equity bull market. So not to get, we've been saying we still think this equity bull market has legs. It's not running away from us. It's not a re-rating. It's really fundamentals that are driving it. So very important to note. Food and energy prices still very much under control. Wheat actually fell to $5 a bushel. As recently as a year ago, it was sitting at about $6. So very deflationary. Oil sitting at $62.50, kind of the midpoint of where it's been over the last year. South African inflation, headline inflation dropped a bit down to 3.3%, and then core inflation sitting at 3.1%. So again, no inflationary pressure, inflation very much under control. We have done a few rate cuts in the last cycle, obviously a little bit ahead of the US, so we're not expecting any rate cuts locally for the foreseeable future, but we still think markets will be supported by what the US does. Rand dollar exchange rate, indicative of a very risk-on month. The rand strengthened from about 17.65 to about 17.25. Quite a strong rand over the month, and just another sign of just that kind of risk-on appetite for investors in the current markets and the current climate. So even though you saw that strengthening of the rand, offshore still did phenomenally well for us in our funds. US SA 10-year bond spread still sitting kind of a midpoint over the last year at about 5%, so still very juicy on the local bonds. And feeding into that, the ALBI, the local bond market, returned 3.3% for the month. And we've liked duration for a long time. We've liked government bonds, especially in the longer end, for a while. And again, just rewarded with that through the course of this month, up 3.3%. Yield curve came down obviously on the rally in South Africa. On the long end of the curve, that yield curve did flatten a little bit, but we still think steep enough that it's still offering very, very good value on the long end of the curve. So we're still quite happy with our holdings there. And with that 5% SA US spread, we still think it's just very attractive. And we've been rewarded on the bonds for a while now, if you've listened to previous voice notes from me. And then the local offshore bonds, so the G7, the developed market bonds, up about 60 basis points for the month. So a decent return from them as well. So pretty much across the board, just very good performance. As I say, we continue to we think that this will continue. It's really driven by fundamentals. It's not driven by hype at the moment. It's something we're always aware of, but at the moment, still very happy. So essentially, going forward, you've got the resuming of a cutting cycle, an interest rate cutting cycle in the US, which we think will be bullish. And on the back of that, just really good earnings coming out, exceptional earnings coming out of those US stocks, which is just supporting that rally. So you'll still, I'm sure in the interim, you'll still see, sort of short to medium term pullbacks in the markets, which are just part of normal healthy markets, and it's normal. But long term, we still very much see this bull market intact. It added to that a lot of cash sitting on the sidelines at the moment. So it's not a very loved bull market rally. I've mentioned that in previous voice notes, and we think that cash will also start to come back into the market as part of the sort of FOMO trade eventually as well. So just everywhere we can see, I'm just supportive of equities still, and for the right reasons. Very important to note that. So the funds, our suite of funds has done phenomenally well over September. Obviously, if you want any more detail on that, you can see our fact sheets or chat to one of our team. But until next month, we hope, as always, if you need anything from me or the team, please give us a shout. And if not, I will definitely release another voice note for October. All the best. Have a great day. Bye.